selected speaker for today's virtual CP seminar, our own young member, CA Ashin Kurian Tom, Vice Chairman and Secretary of the branch, CA Shivrasad sir, Treasurer, CA Dinesh K. Kumar sir, Managing Committee members, all the illustrious past chairmen of the Kannur branch, my fellow members in the profession, friends, and my dear students. A very good evening to all of you. Today we are delighted and extremely happy that our own member and young brother in profession, CA Ashin Kurian Tom, is presenting a paper on a novel topic on share market transactions and its taxability. I am very happy that we are in line with the intention of the institute to promote and encourage the young members of the profession, and we are conducting seminars with our own young members as speakers. We had such young members empowerment seminars during last years, and this year also there will be a series of such programs in the month of June and July. Dear Ashin, we are extremely thankful to you for accepting our invitation, and on behalf of the Kannur branch of SIRC of ICAI, I extend a very warm welcome to you to this virtual CP seminar of the branch. Welcome you, Ashin, and wish you all the best. I also extend a very warm welcome to all the managing committee members, all my senior members in the profession, friends, and to my dear students. Welcome you all. Dear members, please remember to fill and submit the Google form, which is already shared in our WhatsApp group to get the mandatory CPA credit. Please also remember that on 25th June, that's next Friday, the past president of ICAI, CA Manoj Furnisar, will be addressing us on the topic New Code of Ethics and Disciplinary Mechanism. CA Babu Abraham Galivel sir and CA Jomon Kejor sir will also join us on the seminar. Please note the time, it will be 5 p.m. to 7 p.m. Now I request CA Saugan Suresh to formally introduce CA Ashin Kurian Tom to the participants. Saugan, please.
Good evening to all. I am extremely delighted to introduce before everyone the faculty of the day, CA Ashin Kurian Tom. He completed his schooling from Merigiri English Medium School, Srikandapuram, where he was also the class 12th topper. After completing his schooling, he pursued his career in chartered accountancy by doing articleship in CA Jatin Sangvi and Associates, Chennai. He qualified as a chartered accountant in the May 2018 attempt, and he has been holding certificate of practice from August of 2018. He was also awarded the Best Presenter Award by the Kannur branch for the GMCS batch of June of 2018. After qualification, he worked as an audit manager in Sajeev Associates Angamali, where he carried on all major operations. And presently, he is carrying on his own practice under the proprietorship of Mrs. Ashin Kurian and Associates. He has also completed certificate courses on GST as well as concurrent audit on banks. With these few words, I formally introduce the speaker of the day, CA Ashin Kurian Tom, and I also wish him the very best for his presentation ahead. Thank you.
Thank you, Saugan. Thank you for the introduction. And now I request CA Ashin to proceed for the presentation. Ashin, please.
Sir, is it visible now?
Yes, visible. Ashin, proceed.
Yes, good evening, everybody. Today, 21 June 2021, it is the International Yoga Day. And also there is another speciality for today. Today is the longest day. If you look outside, even at 7 o'clock, you can see the daylight. So this is the longest day in this calendar year. And this very beautiful evening, I'm excited to be in this webinar presenting on the topic share market transactions and its taxability. Before that, I would like to extend my happiness to Mr. Shauband, who gave a great opening introduction for the seminar. Also, I express my sincere gratitude towards our dear chairman, CA Registrar, for this opportunity. And I also thank the treasurer and secretary who helped me in presenting this paper in front of you. Now, before we start, we'll start with two questions. Now, two straightforward questions. The first one, whether you will invest in share market or not, or whether you would invest in share market or not. Now, if you like, you can put it in chat, just the answer yes or no. And the chairman can view all this, review all these answers here. But definitely, yeah, the coming chats are coming. Yes, yes. Yeah, people are telling yes and no. Yes. The reason behind people telling no, there will be solid reasons for them also not investing in share market. The first and foremost thing people tell is that share market investment are riskier. Yes, of course, there are safer returns. Safer returns means which will only give you below 10% returns. No, like the bank FT, PPF, which you will getting cumulative interest on the PPF, but the maturity period is 15 years, and also the chitty and other small sorts of investments where you get safer returns, which will be surely less than 10%. And the second point, the second reason they'll tell why they will not choose to invest in share market is share market is a place for gambling. Now people play with the money there. Now, of course, this mythology, this myth is there among many of us. Now we have heard all about all these myths also. Even I have a live example. Now, after clearing the chartered accountancy examination, after with a few months' salary, when I have invested in stock market and I've told it at home, and the response that I got, it was almost like that I have funded it to a mafia or an underworld gang. No, it's they think that it's a dirty business. It's a dirty place where you put the money. Now all these myths are there, but in few minutes I will be segregating with this gambling or the speculative type and with the investment in the stock market. Now we will come to that point. And beginning, I've told about two questions, and the first question was just clear. Now the second question, whether you need to buy a share in stock market. And I would say the answer to that, or I would suggest that you should buy a share in the stock market. Now, what is a big deal in buying a share? Just a share. Now, if you don't like to invest in stock market, it's fine. No, but buying a stock in share market, I'll tell you the few advantages. No, every year you will be getting the annual report. Suppose you buy or you bought a share from Infosys. Now, every year at your desk, you will be receiving the annual report, and also you will be called for the shareholders meeting. From the annual report, you can study and understand how the financial statements are prepared, how the consolidated financial statements are prepared, and also the segmental reporting and many other things. Even the notes to financial statements, the best way you can present it. It is always good for the fellow members, the article students, and even anyone who is interested in learning about stock market, the financial ability, the fundamentals of a company. It is always best to have a particular share rather than investing. So from these questions, we can come to a conclusion that investing in stock market is a choice for you, but buying a share in stock market, it's a must. It's a must to be in this profession. Yes. Now we'll see the journey path of this particular webinar. Now we will be having three type of sessions here. Three types. Three categories we'll take. In the beginning, for a few minutes, we will be taking about stock exchanges and when, what, where all this happens, and few facts and ideas about the stock exchanges. And the major portion we will be discussing about the direct and indirect tax applicability of listed shares and securities. Now, of course, we are talking about the share market, and these things will be listed. So our focus will be on the listed shares and securities. And towards the last, we will be discussing on few tax planning sections, the methods, and how it can be made practically possible. Yes. Before getting into some deeper discussions, we will start with something very simple and which is very familiar. I have taken out 6 company and its names here. You must have heard about all this, and some of you are, and some of us have already used the services or the goods of few companies listed here. Of course, and anybody here can point out any similarity between these 6 companies here. Anybody? Now, all these are listed companies, yes, of course, but any other similarity can you come out with? You can put in the chat. Interested? No need to sit simply. You can put it in the chat. Can be engaged. Yeah, chats is coming. Yeah, Of course, now everybody is coming in, right? All are Kerala-based companies, correct? Yes, all these are Kerala-based companies. No, but many of you have a doubt. No, why Geojit is here? Now, this name sounds like a North Indian name. We thought many people have a myth on this one also about Geojit. Geojit, it was formed by George and Ranjit. No, that name, both of them joined the names and formed it as Geojit, a Kochi-based company. Yes, of course. And one more fact I would like to call upon. Now, all these have been listed. Some long back and some very near. Can you tell me which is the company which has been come out to public issue or the IPO was done this year? One of these companies IPO was done this year. Yes, again chat is coming. Yes, it's a Kalyan Jewelers. No, the latest IPO was out of this particular company. Yes, of course. Now we'll slowly move to other sections. Stock exchanges is the place, where we buy and sell shares. Sell not only shares, but derivatives also it is there. Not only shares, listed shares and securities. Yes. All around the world, stock markets are now not run on paperwork. Everything is electronic. Now the technological advancement has changed the working style of stock exchanges. Now you need not even go anywhere. You can sit simply, even if you are traveling, you can buy and sell shares. Now things have changed all on a sudden. And you can see a sudden rise in retail investors from the last corona time, from March onwards. So all the chartered accountants here, your client who already have some other business income, maybe from last corona time, after the March period, they must have started investing or they must have started trading in stock market. No, this extra portion of income, you have to deal it properly with the Income Tax Act and other related tax acts also. So the normal timing, the trading time will be from Monday to Friday from 9:15 to 3:30 as of in India. And what all companies are listed in stock exchanges means even from the agricultural sector to all the IT sector, there is no difference. Everything are listed in stock exchanges, and that you can see here. Yes. Now, overall in this world, before we move to about Indian stock market, we can see which is the largest stock exchange in the world. We know which is the most powerful country, and that country is having the highest or the largest stock exchange in the world, and that is none other than this New York Stock Exchange. You can see here the New York Stock Exchange floor, and this is the front side of the New York Stock Exchange. You can see the flag, the Wall Street is there. Yes, why they are big, why they are so large. The reason is that their market capitalization is so huge. When we compare with India to the New York Stock Exchange, it is almost 12 times. You can see here $24.49 trillion is the market capitalization of the New York Stock Exchange. And a lot of blue chip companies have been listed. There are almost 2,400 companies listed. Even Johnson & Johnson, JP Morgan Chase and Co. all are listed there. Now, when we come to India, the two stock exchanges in India, one is BSE and the other is NSE. Now, the Bombay Stock Exchange is the oldest stock exchange in India, and the NSE is the new stock exchange, which is formed in 1990s, and BSE before that. And almost 5,000 companies are listed in BSE, and in NSE almost 1,600 companies are listed here. So the market cap between these two stock exchange will be different, since different companies have been listed there. Their market cap will be different, and both these exchanges are regulated by SEBI in India. Securities Exchange Board of India controls both of them. And now, which is the largest derivative stock exchange in the market or in the world? I hope everyone knows about the derivative market. Now, telling about derivative market. Derivative is a security whose value is derived from another financial entity referred to as underlying asset. So, derivative takes its value from an underlying asset. Suppose if there is a derivative of TCS share, where do the derivative or the derivative of TCS gets its value? It's from the actual share value of TCS. So how does it work? When the original TCS share price goes up, the derivative value also will go up. Now, how we can buy the derivative? It can be told as futures and options. We buy it as futures and options. So we can tell that derivative is like, it is like doing a mimicry. A mimic is doing when the original share price moves up, derivative value also move up. So it can be called as a mimic. Now it is not only about stock but also about the commodity. Now why many business people do derivative? It is to hedge their risk. The movement in the price fluctuation, they take an opposite action and they hedge the price fluctuation. Even in currencies, currency fluctuation can be hedged using a derivative market. Yes. So in the world, which is the most biggest derivative stock exchange, it is none other than the NSE. NSE in India is the largest derivative in the world. The index used will be the Nifty, and almost 1,600 companies are listed here. You can see the market capitalization here. It is $2.57 trillion, and earlier you have seen that the New York Stock Exchange has almost 24 trillion, almost 12 times. Now here I have taken the chart pattern of NSE. NSE index is Nifty. BSE index BSE index BSE index is Sensex. Now why I have taken the graph here is to make you understand. In the beginning I have told that their market capitalization are different, since both of them have different types of companies, so market size will be different. Now the figures here is the present value of Nifty or the NSE stock exchange. It is 15,779, and the Bombay Stock Exchange is 52,474. Yes, of course. Now you can see here, when it was formed in 1991. Now I have taken a monthly chart here. You can see it's monthly, and these are candlestick. Now every candlestick, this means the monthly movement of a share, monthly movement of the Nifty, or the cumulative of Nifty 50 shares. The green candle shows that it was positive. It was positive during that month. The red candle shows that it was negative during that month. When it started from all from 1991, it started slowly moving. Now it goes up, it goes down, but in the growth phase. All the way from here to here. This I have taken just to show similarity between NSE and BSE, and also the power of investing. The power of investing you can see here. When you have invested in a good growth making company, your share will definitely go up. Now you can see the pattern here. Now this is the correct movement of any share. But here you can see that all on a sudden there is a sudden fall. When the Nifty was above 6,000, it came down almost to 2,000. And this period, 2008-10, the global recession was during this time. And you can see here, not only from the fundamentals of a company, maybe fundamentals of many weak companies were there who stopped the business during that recession time. Now you can see that pattern here clearly in the chart also, this recession. Then later economy has taken a step from there and started moving. Now it broken the all-time high from the global recession, and it broken everything, then went up, and all on a sudden again a fall. You can see here above 12,000, it came to 7,500 here. And you know that year 2020, it is the corona time. The first wave hit the stock market, and it came all from the top to the bottom, and after that it went up. But you cannot see an impact in the second wave here, because why it came from here to here was the good news of vaccination. Now it taken up to the market. And now if you look at the chart of BSE or the Sensex is the index here, index for BSE. You can see from 1980 to 1991, it was nothing, it was just the same. Then when NSE was formed, you can see the same pattern. 2008-10 recession, then slowly started moving, breaking all-time high. Then you can see the same depth here, the fall here in a first wave of corona. Then again it went up to the same. Now, even though the market capitalization is different, the chart pattern or the growth in both BSE and NSE is same. And another interesting thing is that any share you buy from NSE, even that can be sold in BSE also. There is no problem. But that cannot happen for an intraday like speculative transactions. What you bought from NSE can be sold in that day also. That we'll be discussing later. And this is all about BSE and NSE here. Now I will introduce before you two successful investors. Now one from India and one from the outside India. Yeah. This is two famous people, Rajesh Jhunjhunwala and Warren Buffett. You know, why I have taken this particular slide to you is to understand the power of investing, the power of being long term. You know, in the beginning, I've told that people always love risk-free returns or risk-free interest investment modes like FT 6%, or 7%. But see, in 2019, Jhunjhunwala was holding these 5 shares. The number of years he was holding it. Titan 17, Escorts 5, VIP Industries 9, all this he was holding it for these much years. And CAGR is the average return. Suppose he was holding it for 17 years and every year he was having 37% return from this particular share. Now, isn't it amazing? He won't be getting that much return in any other safe returns. He has got it. Then Escorts, he has got much bigger than that, but only 5 years. But still he has got 39% every year. And going to Warren Buffett, he was telling on investment, what he was telling, his famous quotes is that do not put all eggs in one basket. Even Jhunjhunwala did not tell about this particular statement. He has shown us practically that he has not put every money into a single stock and taken a risk. He has put it in separate growth making good companies, and that has made all the risk, that has made all the money for him. Yes, and many other beautiful quotes are made by him from his studies, and there are a lot of books written by him which are worthy of reading it. And another famous quote by Jhunjhunwala, famous quote, it is buy right. Buy right means buy the right share, means good growth making companies, and hold tight. Whatever news comes, you hold it, you will be getting the returns as is shown in his practical life. Yes. Now here I have taken 4 charts. 3 companies here you can see. It's SBIN, State Bank of India, PVR, and Asian Paint, and this is Nifty 50, of course the index of NSE. You can see here, it is a monthly chart, candlestick chart it is. Every candle shows the price movement in a month. Red candle shows it was negative during that month, and the green candle shows that it was positive during that month. Yes, from 2015 to 2021, it was moving in almost, it was going in a good guide. From 7,500 it went to 12,500. During Corona time it fell down. During Corona time 2020 it fell down. Yes. Look at the chart of Asian Paint now. From Nifty 50, look at the chart of Asian Paint here. It was almost the same going, but you cannot see a fall here. It was going in the same pace, and it has accelerated the pace after the Corona growth, Corona effect, I guess. Now Asian Paint, keep it in mind. But see SBIN and PVR, Corona impact 2020. You can see the same fall here in SBIN. You can see a bigger fall in PVR, a bigger fall in PVR. But in SBIN, you can see that even after the fall, it has gone all-time high. Before Corona, where it was gone above that now. So it has made a comeback. Some few public sector banks, new initiatives by the central government made the extra pull in the previous months that made little more higher. But you can see that State Bank has made a comeback. But look at the chart of PVR. It has come down, but it has not even reached where it was before Corona. You can see. So people who wants to invest in good growth making companies, whatever be the news, our economy has to grow. Our country, India, it's a developing country. Our roads, our electricity, housing facilities, all these needs to be developed. So much of economical activity is still there in this country to be done. So anybody who is fundamentally, technically strong, can invest in good growth making companies and have a better returns than any other safer returns that you can have. Yes, and this is all about the charts. I can share you about this one. Now we will move to the second part of our journey in this particular webinar. Now we will be talking about the taxation point of view. Basically, two taxes which comes to our mind when we hear about tax. One is income tax, and the second one is GST. Now, first we will take about GST. Whether a person who do or who rather than investing do intraday, means a speculative or non-speculative, like buying futures and sellers. That means they are doing a business transaction. Now, if whether they are required to take GST registration, are they required to take GST registration? No, if you know, you can comment in the chat about this one. Yes, that's a yes, no, yes, they're telling no, yes. For GST, normally when the turnover crosses 40 lakhs for goods cases, you are mandatorily required to take GST registration. But in the definition of goods under section 252, it has excluded the term securities. Thereby, trading in shares is not a supply there. So the traders need not take GST registration since they are excluded from the definition of goods, and thereby it's not a supply. So GST taxation, it is out of our purview here. Now about income tax. Yes, any income that you make from India, it will be taxable under income tax. And yes, and our discussion will be only on income tax. Now a very important point before we get into whether it is a capital gain, whether it is speculative or non-speculative. Now we will be seeing particularly this circular here and how it can be divided into a business income or a capital income. I hope many of you know that how we categorize it as long-term capital gain and short-term capital gain. Anything you hold for less than 12 months, that will be considered as short-term. Anything you hold it for more than 12 months and sell, it will be long-term. But a lot of confusions existed. Earlier circulars came that when you invest in stock market with the intention of getting dividend, then it is a capital income. If you do not get dividend, then it is a business income. You are doing some trading. Only on the record date, if you hold the share, you will be getting dividend. Or if the company did not declare any dividend, then also that will be coming under business income. Now, earlier lot of confusions was there, and lately the circular 6/2016 came upon to reduce the litigations and doubts in the minds of taxpayers and chartered accountants. 3 points listed, 2 we need to discuss very carefully here, where assessee itself. So assessee can decide himself that whether a listed shares or securities, irrespective of the period of the holding. That means whatever be the period of holding, he can treat it as stock in trade, and thereby it will be a business income. No, that means earlier the power was with the assessing officer to declare it as business income or capital gain. Now it lies in the hands of assessee that he can treat it as business income or capital gain even irrespective of the period of holding. Yes. Now the second one, in respect of listed shares and securities. In case of listed shares and securities, if it is held for more than 12 months, and the assessee decides to treat it as capital gain, the same shall not be put to dispute by the assessing officer. So it is a desire of the assessee whether they can treat it as business income or capital gain. But very important thing that you have to note in mind, every year it is not the desire of the assessee which is important. Now once a decision is taken by assessee in the first year, then in the subsequent years assessee needs to follow the same pattern. You can see here, however, this stand once taken by the assessee in a particular assessment year shall remain applicable in the subsequent assessment years also, and the taxpayers shall not be allowed to adopt a different or contrary stand in this regard in subsequent years. And the sole objective of the reducing litigation and maintaining consistency in approach is maintained by this particular circular. So if you are a trader and it is considered as a stock in trade, so you will be a trader. If you are an investor, it is considered as capital asset. So it is the desire of the assessee which will decide, but which cannot be changed in the subsequent years. You have to maintain the same level. Yes. Moving now, like the heads of income we study in income tax. Now heads of income which will come in this stock market transactions, so the share market transactions. Now of course the capital gain, long-term capital gain and the short-term capital gain. And here you can see the speculative income. Now what is speculative income in share market is the intraday trading. We will discuss detail all about all these 5 heads of income and their taxability. And the non-speculative income is the futures and options which you trade in stock market. And another what you can call like an indirect income. Only for an investor it will be an indirect income, like they can show it in income from other source. For business people, definitely this dividend will be shown as business income only. So all these 5 income we have to know the tax impact. Yes, first we will discuss about capital gains. We know that capital gains can be categorized into 2. One is long-term capital gain, which is taxed under section 112A, and another is short-term capital gain. Now the criteria how these are categorized is their holding period. The holding period. Now suppose you buy a share on 1/4/2020 and you sell the share on 31/3/2021. Now you hold it for a period of correct 12 months or 365 days. Up to 12 months or up to 1 year you hold any share and sell it. No, not more than. It is up to 12 months. That can be called as short-term capital gain. It is straight away short-term capital gain, and the tax rates. Now when we talk about their tax rates, it is not based on a person's individual slab rates, like for up to 5 lakh 5% in the old regime, 5 lakh to 10 lakh 20%, and about 10 lakhs sorry, about 20 lakh, about 10 lakhs it is 30%. Now here you have to pay flat 15% on short-term capital gain. And if you hold it, the holding period is more than 1 year or more than 12 months, that will be a long-term capital gain, and it will be taxed under section 112A. And the income, the total income for long-term capital, if it is up to 1 lakh, you are not liable to pay any income tax on that. But if your long-term capital gain is above 1 lakh, you are supposed to pay 10% exceeding the 1 lakh. Before that, we can see how this holding period can be viewed. It's a practical example. It's a practically taken. Now this taken a screenshot of this one. Now it's BEL, it's the Bharat Heavy Electric Limited shares you bought. Now you hold it for a period of 83 days. If you hold it for a period of 83 days, definitely it will be short term. Now here you can see Hindustan Unilever. If you hold it for 783 days, definitely it will be long term, because about 365 or about 12 months it will be long term. And this Wonderla share, now you have bought it in different dates, different quantity. Now first you hold it for 12 days, and the second it was about 67 days. Both are below 365 days, or below 1 year, or below 12 months. So definitely that is gonna be uh, shorter. So 15% flat it will be charged here. Long term, if the income is exceeding 1 lakh, you will be taxed at 10% on exceeding 1 lakh income. And here, since it was short, it is flat 15%. You know, we will be moving on the next slide about the gift. Now we are talking about the holding period in capital gain here. When you get a gift from your relative, you get a gift as a stock to your holding in a demat account. Now what will be the holding period, or what is the taxability? Gifting it is not taxable as per section 45, as it is not a transfer, so it is not coming under capital gain, so it is not taxable. But the holding period determines whether it is long term or short term. You hold it for 5 days, getting the stock, don't know what to do. In 5 days you sell it, you get the money. Whether it should be considered as short term or whether it should be considered as long term. The holding period when you get a stock as a gift should not be counted only from your holding point of view, but it should be taken from the previous owner holding period also. He must have been holding it for 10 years, 15 years. So definitely, if it is more than 1 year, you should consider it as long term only. Yes, and this holding period, I think you must be clear about this particular topic. And now we will move about short term and long term capital gain. Now first, long term capital gain. Now a long term capital gain to be taxed under section 112A, needs to satisfy these 4 conditions. 4 conditions. 1, it should be a capital gain. Who decides it should be a capital gain? Now we know, as per circular number 6/2016, assessee decides is to be treated as capital gain, he can treat it as capital gain. Condition 2. Now what are the transferring assets? Not what should be transferred for a long term. It is the equity share in a company, or unit of an equity oriented mutual fund, or a unit of a business trust. The condition 3. STT must be paid at the time of transfer. STT means the security transaction tax. Later we will see separate slide on STT, and it's a taxes, difference in taxes in capital gain, intraday and futures and option we will be seeing later. Security transaction tax must be paid at the time of transfer. So if it is not paid, then it is not taxed under section 12A. Suppose you buy a share from stock market. Now you sell it in the offshore market, the off market. No, you will not be paying any STT. Means the security transaction will not be paid when you sell it outside, or you sell it to close friend. No, it is not there. So it will not be taxed under 112A, but it will be taxed under section 112. Yes. In condition, the next condition is condition 4. It is told that even at the time of acquisition, STT should have been paid with effect from 1/4/2004. Any share you bought after 2004, STT should have been paid at the time of acquisition also. So then long-term capital gain under section 112A will be only then be applicable. Now I have taken various deductions and details of short-term capital gain as well as short-term capital gain together in a single slide here. Now it's very interesting. The first 2 points are common for both. STT should be paid. It should be in a recognized stock exchange, NSE or BSE. And the important points. First we will go from here. Chapter 6 deductions. Whether it is available for a long term or short term. For capital gains, it is not at all available. Indexation, it is only available for long-term capital gain, but when it comes to 112A for listed share securities, unit of equity or a mutual fund or a unit of a business trust, definitely it is not there. It is not available. And 87A rebate, it is also not available. 87A rebate, it is nothing but it is available only to individual resident. Very important, it is available only to individual resident, not available for non-resident also. When their income does not exceed 500,000, means if their income is below 5 lakh, they can take this particular provision to get a rebate, and that is also not available. So if your total income is above 2,50,000, if your salary is 20,000 per month, you get up to the total income of 2,40,000, and you made a short-term capital gain of 20,000. So your total income now is 2,20,000, 2,60,000, and on the income above the basic exemption of 2,50,000, that 10,000, you are required to pay 15% short-term capital gain, which will be 1,500 plus health and education cess also you will be supposed to pay. So that is the impact this 87A gives on small income earning persons. Basic exemption limit. This particular basic exemption limit, it is available for the resident, as we have seen. It is available up to 2,50,000. Even if they earn any capital gain income, it will not be taxed. But anything above 2,50,000 will be taxed. But the unfortunate thing for non-resident, it is not available. It is not available for capital gain cases. Even if they earn just 10,000 rupees, they will be supposed to pay whatever be the amount. And always for non-residents, TDS will be deducted on their gain. Yes, and we have already seen that we are taking flat rate of 15%, and income above 1 lakh for long-term capital will be taxed at 10%. Now, earlier there was a provision of 1038 in the income tax that long-term capital gain from listed securities will not be taxed. It was wholly exempt. Now, when the finance bill was presented on Lok Sabha on 1st February 2018, things changed. Now, anything above 1 lakh income on total long-term capital gain will be taxed at 10%. Yes, will be taxed at 10%. So, a person who has planned his investment that long-term capital gain will not be taxed. No, he felt guilty that why this government is doing such a thing. Now, I planned my investment in such a way that I will not be taxed. But now the government has come up suddenly with a tax on long-term capital gain. Now, to safeguard their interest, what government has made another small provision. No, it's called the grandfathering provision. Now, it helped them that before presenting the finance bill on 1st February 2018, so that means on 31st up to 31/1/2018, whatever be the unrealized gain they make on long-term capital gain, that will not be taxed. Now, they made a provision such a way that cannot be taxed ultimately. Now, we'll look at that particular provisions here now. It's a grandfathering provision under section 12A, where long-term capital gain is taxable under section 112A. This can be applied only under section 112A, where STT is paid. 112A speciality is that one of the condition is that STT should be paid. It is applicable for equity shares or units acquired before 1st February 2008, because 1st February is the date when the finance bill was presented in the Lok Sabha. So before that date, it is applicable only for those units which was purchased before that. And the cost of acquisition to be calculated as per section 55. And this particular cost of acquisition calculation has safeguarded the interest of long-term investors by this particular grandfathering provision. And why grandfathering provision? We will see again that on that. Now, how cost of acquisition is calculated? From this calculation, you will understand that how they are safeguarded, their interest, how government safeguarded. Usually, if you buy a stock for 1 lakh rupees and we sell it at 5 lakh, we will have a long-term capital. Suppose they hold it for more than 12 months, their long-term capital gain will be 4 lakh. But suppose their actual cost of acquisition is 1 lakh. On 31/1/2018, suppose the fair market value means the highest share price quoted in the exchange on this particular day. If it is some amount of that particular share and the 1 lakh value has become 3 lakh, that means extra 2 lakh earnings they have made, that should be exempt, right? This fair market value on 31 January, suppose that value came to 3 lakh, and sale consideration, we know that he has sold it after 2019 maybe at 5 lakh. Now at 5 lakh, now we have to take the lower of these two, 3 lakh or 5 lakh, which is lower. 3 lakh will be the lower and a 3 lakh will be taken here. So higher of actual cost of acquisition or 3 lakh, means 1 lakh or 3 lakh. We will be taking 3 lakh as cost of acquisition. So when he sells it at 2019 for 5 lakh, his cost of acquisition can be taken as 3 lakh, and on the rest 2 lakhs only he needs to pay the tax. That means the income, the unrealized income he earned till 31/1/2018 has become exempt by this grandfathering provision. This is how government safeguarded those investors' interest. So I think this capital gain portion, we have almost covered most of the points. A few more discussions will be coming in coming slides. Yes. Now we will be moving to the second pattern of income. First we have seen capital gain, that is long term and short term, and now we will be moving to business income, that is speculative and non-speculative. Now after this, one more head of income is there, that is the dividend. Now we need to look at this business income. Business income can be categorized as speculative and non-speculative. Now, why we need to distinguish between speculative and non-speculative? Now, this is very important. Even our act has specifically given that non-speculative and speculative has to be segregated or distinguished. Now, speculative is nothing but it is the intraday. Now we'll be discussing on intraday. Intraday is buying and selling of shares within the same day. Buying and selling, or selling and buying within the same day. So a person who comes to do intraday in stock market, now his intention to do the transaction is not to have the goods, is not to have the share, but to get the benefit out of the goods or out of the share. It is just that. So the important point which we need to stress here, that there will be no delivery of stock here. There will be no delivery of stock here. Whenever there is no delivery of stock, it is speculative. It is straight away speculative. Then what about futures and options? Futures and options also there is no delivery, but Act has specifically told under section 43 subsection 5, it has specifically told that under speculative these things have been told that, and it has specifically told that these shall not be deemed to be speculative, so it became non-speculative. So with these two categorization, we can tell that intraday as per section 43.5. And why futures and options are non-speculative? Because Act has defined like that. No, we can tell only like that. By the normal definition of speculative, futures and options are also speculative, but income tax has defined in such a way that it became non-speculative. Now we will see it later. Now the tax rate on this is not the flat rate as of capital gain. It will be the normal slab rate of the individual, whatever be the income, it will be under the normal slab rate only. Now here you can see under section 43 subsection 5, now speculative transactions, speculative transaction, I have taken the exact words from the Act. Now contract for the purchase or sale of any commodity including stocks, shares, periodically or ultimate sale, otherwise than by the actual delivery or transfer of commodity or scrips. And this is what I have explained before. Then all that will be speculative, and for our income tax purposes, speculative means intraday. Provided that now they have quoted 5 things, and these 5 things, even though they are speculative, shall not be deemed to be speculative transactions. Now you can see that trading in commodity derivatives, trading in derivatives, eligible transactions in recognized stock exchanges. This is in commodity stock exchange. So take upon this. Speculative transaction. Speculative transaction, it is a contract for purchase, periodically settled, otherwise than by actual delivery or transfer of the commodity or the scripts. And that is intraday calculation. We know that speculation will be intraday. Buying and selling stock on the same day. Here actually there will be only squaring of the difference. You buy a share in the morning for 5 lakh rupees, and before closing the trading on that particular day, before 3:20 or 3:15, you need to square off the transaction, and you sell it at 5,50,000. What? No, you are not gonna sell any share, you are not gonna take any shares. Now what will be settled at the end of the day is 50,000. You earn 50,000 and 50,000 extra will come to your demat account. Now to make it little more clearer, we need to know about the settlement period here. Settlement period. Normally, the settlement period in stock market is T plus 2 days. That is transaction day plus 2 days. Suppose you bought a share on Monday. That is a transaction day. It is a T day plus 2 more days. That is Tuesday and Wednesday. Now, at the end of the day, only that particular share will come to your holding account in your demat. That means practically on the fourth day, on Thursday morning, only this share will come to your demat account. So when you buy and sell a share on a particular day, delivery will not be happening. So all those things will be squaring off on the same trading day. That is written here. No actual delivery. Intention to earn profits from fluctuations in prices only. There is no intention of actual delivery. Yes. Beginning I've told that we need to segregate or we need to distinguish between speculation as well as non-speculation, and this distinguishing portion has been given in explanation 2 to section 28 of the Income Tax Act 1961. Here, speculative transactions shall be deemed to be distinct and separate from any other business. So a person who do intraday, a person who do futures and options, even if they do it, we need to segregate both and then we need to file. Not only because the act told it like that, for another purpose also it is very important, and that section 73 tells us. That means losses in speculation business. Suppose you made a loss in intraday for this particular financial year. Now there are provisions for setting of the loss with the gain, and you can also carry forward the loss and set off in the future years. For speculation, you can carry forward normally for 4 assessment years, and you can set it off with only with the speculation income, not with any other business income or not with any other income. So that is why segregating speculation with any other income is very much important in your share market accounting. Now, just we can summarize here like that. Speculative income, it is intraday without the intention of taking delivery. Non-speculative, you can see that trading in F&O, specifically defined this way in section 43(5). Even though there is no delivery in that, even though there is no delivery happening in future and options also, Act has specifically defined it as non-speculative. Now this is also very much important. The expenses allowable. First, we can see here business income. So it will be very easy. All charges when trading. That means there will be SEBI charges, there will be brokerage, there will be securities transaction tax. Every charges to stock exchange charge upon you can take it as expense. and all other expenses like internet bills, depreciation on computer, rent, salary, advisory, cost of books, newspaper, any expenses which is related to stock expense and income, you can deduct it as for business income computations. But for capital gain, no, definitely you cannot deduct any other expenses from internet to the subscriptions here. But there is also another difference. You need to know that all the charges when trading can be deducted except securities transaction tax. It cannot be deducted under capital gain computation. Okay, you have to keep it in mind. This is very important. Losses set off and carry forward. This particular provisions you can see here. Now I'll take it in a simple way. All losses I have taken here: speculative loss, non-speculative loss, short-term capital loss, and long-term. You can see only the speculative loss can be carried forward for 4 years, and all non-speculative 8 years, now short-term 8 years, long-term. All other losses can be carried forward for 8 years. Only speculative loss can be carried forward for 4 years. That is intraday. No, it is not. It is not encouraged. We can say that it is not encouraged. Yes. In practically now, what is happening is that the stock exchange or the SEBI is putting a tight hold on all these intraday charges and reducing the margin given to the traders. Now, earlier, if you have 1 lakh, you can trade up to 12 times of that 12 lakh amount is getting traded in the stock market. Now, that margin is coming reduced because we know that it is speculative. It is speculative. It is not suggested for earning money. Yes. Speculative loss, here you can see that it can be set off for 4 years, and it can be set off only against speculative gains. We have seen that is why it has been segregated between speculative and non-speculative. And here now in the long-term capital gain, long-term capital loss can be set off only against long-term capital gain. Even in carry forward and setting off also, you can set off only with a long-term capital gain. But in the short-term capital gain, capital loss can be set off as well as carry forward and set off with any other capital gain. With any other capital gain means you can set off with short-term capital gain as well as long-term capital gain. In the non-speculative losses, in the particular same year, you can set off with any other income, but except salary. Except salary, you can set off with any other income in that particular year. Suppose in futures and options, you made a loss of 5 lakhs and you have a salary of 7,20,000. No, you cannot set off with the salary income. You should have some other income. You should have some other income. Carry forward for 8 years, it can be carried forward. But in the carry forwarding and set off, it can be set off only against non-speculative incomes. It can be carried forward and set off against only non-speculative or any other business incomes. We can tell that any other business incomes. Yes. And carry forwarding and setting off is allowed only when you file the income tax return within the due date. If you do not file the return within the due date or belatedly you file the return, this benefit of carry forwarding of and setting off of loss is not given to you. The benefit is available only to the responsible taxpayers or tax filing persons. Now, all this time we have been hearing about the securities transaction tax. Now, all this time STT has been paid. No, long-term capital gain 100 section 12A, one of the condition is that it should be paid at the time of transfer. What STT should be paid at the time of transfer. Now, how it is charged? Now, we can see that it has been levied on the value of taxable securities transaction. No, it is valued on the taxable securities. It is charged on the purchase or the sales. Now, there are different ways. It is charged. For delivery it is different, for intraday it is different, for futures and options it is different. Now I have taken the practical example to here. You can see here it is intraday, delivery, futures, it is options. Now I have taken the same buy value and the same sell value everywhere, and the quantity also same, and you can see that's why the turnover will be same. Turnover means purchase and selling total turnover it is. No, it is 8,40,000 here. Anywhere, it is 84,000 here. The STT in intraday, the STT is 110. In delivery it is 840. In STT it is 44, and in sorry, in futures it is 44, and options it is 22. So we can understand that every type of income that you make, no, they charging STT differently. Now highest will be charged in delivery, that is purchase value and purchase and on sales. On purchase and on sales they charge STT at 0.01 percentage. Here only on sales, and that is different percentage. Here only on sales, and here only on sales, and the sales percentage will be entirely different. You can see here now, when we discussed about expenses allowable, the first point was all charges, including all charges in trading. These are the charges, or these are the expenses that is coming under trading. You can see here STT, brokerage, securities transaction tax, then exchange transaction charge, GST on GST. This particular amount will come on STT, on brokerage. On brokerage, the brokerage firms will be charging GST on us, and SEBI charges will be there, stamp duty will be there. So total tax and charges, you can watch it here. This is a whole summary of that, how much percentage they are charging. GST, brokerage plus on transaction charges they are charging on us. SEBI charges rupees 10 per 1 crore. Stamp duty, everything they have segregated for futures and options and everything here. And all these will be different for all the participants, and all the different types of incomes. Now I've taken this securities transaction tax such lately because of this particular point I need to discuss. Now earlier I have told about settlement period. Settlement period is T plus 2 days. Now if I buy on Monday, that will come to my demat account on Thursday morning practically. Suppose if I buy on Monday and sell it tomorrow or day after tomorrow, whether it is speculative, because from the definitions we understand that when there is no delivery, there was no intention of taking a delivery of the share, it should be speculative. So BTST means buy today, sell tomorrow. No, buy today, sell tomorrow. Before the settlement period, it is sold. Holding period is 1 day. No, it is another term. It is acquire today, sell tomorrow. Here there is no delivery of the stock. Even though from the definition we can tell it like that, even the stock exchange themselves charges STT like a normal delivery based trade. From here we can understand that for intraday the charge on STT is different. For delivery based, the STT is different. So even the exchange, they consider BTST as delivery based trades. So it is non-speculative or capital based. Whatever the assessee decides to consider in their income tax computation, they can take it that way. That will not be a speculative one. Yes. Now the interesting point on chartered accountants. Now, whether SCA can buy and sell listed shares through recognized stock exchange. Now another one. Are you allowed to do a speculative or intraday or non-speculative business? No, chartered accounts, I need your answer. I need your views on this. Yes, please. You can put it on chat. We'll see. Now, whether I need answer only for the second one. Are you allowed to do speculative or non-speculative business in stock market? Ganesh sir told it is no. Zuriji is told not allowed. Sujan Pal told no. Sir, am I audible to you?
Yes, you are audible, but the presentation is out.
Okay, okay.
Yes,
Now able to see, right, sir?
yes, it's correct. Good.
Yes, okay. Yes. Now we will see a particular provision. No? In CA final, we have studied about this one. Chartered Accountants Act 1949, first schedule, part 1, clause 11. A very interesting thing. A chartered accountant in practice shall be deemed to be guilty of professional misconduct if he engages in any business or occupation other than the profession of chartered accountant. In any business. So we know that speculative, it's a business. Non-speculative, that is also a business other than the professional chartered account unless permitted by the council so to engage. Now, up to the last year council meeting, I understand that chartered accountants cannot do speculative and non-speculative business transactions. But from some sources, I heard that this year council meeting, they have approved to chartered accountants to participate in non-speculative business. If I am wrong, any members who know about the correctness of it, you can please share here also. But suggestion will be not to do all those business transactions because it is clearly there in our Chartered Accountants Act. I can segregate this. Yes, investment. Yes, definitely. Yes, you can make it. For business, we cannot make it. Practicing CA not allowed. Everyone is of that view. Yes, the chairman of CM has clarified it in the recent webinars. Yes. Now, yes, even I've seen that particular webinar and I am having a doubt on that particular issue, but it is not very clear. I didn't get any particular a clear source that I can present on this webinar here. So I am not going into that part. Now let us get more clarity on that. Yes. Yes. Now, the very important portion on the tax audit applicability for the business people. For capital gain, whether there will be tax audit? No, there will be no tax audit thinking for an investor point. But for a person who do intraday or a person who do non-speculative futures and options, the tax audit applicability needs to be considered well. Now we need to discuss it very clearly here. Now, I will be discussing the extract words from the sections in the later slides, but to simplify the discussion, this slide will be very useful. Tax audit applicability. About 10 crores. First I have taken about 10 crores. What is this 10 crore all about? We already know that above 1 crore tax audit is applicable. But I have taken here about 10 crore mandatory as per section 44 ABA. Yes, I know about 44 ABA, but that was 1 crore. Yes, but there was a provision came in that 44 ABA. In that specific extra things came up. Now we will be discussing it in the coming slides. Yes, between 2 crores and 10 crores not applicable. So that means below 10 crores and above 2 crores no audit applicable. But below 2 crores, now that is a wonder. From plain trading you can understand like that. Below 2 crores, if 44 AD4 subsection gets triggered and your total income is exceeding the basic exemption limit, yes, that particular party needs to get its accounts audited as per section 44 ABE. So for a stock market transaction or for a stock market business person or a trader, the tax audit applicability will be based on 44 ABA and 44 ABE. But 44 ABE to be understood needs to go to 44 AD4 first. Then only we can confirm about 44 ABE. So let us see. The exact words I've taken from 44 section ABA. You can see every person carrying on business. Yes, we are doing speculative or non-speculative. Shall if it's total sales, yes, turnover or yes, gross receipts as the case may be in business exceeds 1 crore rupees in any previous year. Yes, this is what is known to us. Yes, above 1 crore. But this particular provision here, aggregate of all amounts received, that means receipt including sales in cash. So receipt in cash does not exceed 5% of the said amount. And one more condition, payments in cash. So cash payments in the previous year not exceeding 5%. That means there is a tolerance level of 5%. There is a tolerance level of 5%. So if the transactions in the client's account up to 95% is through the banking channel, this provision gets triggered, and what happens, this clause shall have effect as if for the words 1 crore, instead of this word 1 crore, the words 10 crores shall be substituted. Now we know that stock market transaction, nothing is there now done in cash. Everything is through the bank account. Only. We know that when a bank account is getting linked to a demat account, only from that account you can transfer the amount to that demat account. And if somebody knows the password or anything of the demat account, he cannot transfer to some other account. He can transfer it only to the account which is linked. That is the person. So 100% banking channel. You can see even account opening of a demat. Now it is totally paperless. Everything you can done at your home, at your from your system itself. So since this share market transactions will be 100% through banking channel, the tax audit will not be applicable when it just crosses 1 crore. It will be applicable when it crosses 10 crores. This is as per section 44AB(a). And now we will be moving to the important provision of 44AD4. Now 44AD4 first need to get triggered, and also when the total income exceeding the basic exemption limit, that is 2,50,000 for a normal resident, exceeding that, then only 44AB will be coming. So we will be first look at 44AD4. An eligible assessee. Who is an eligible assessee? He should be eligible assessee is an individual or an HUF, and his turnover should be below 2 crore rupees. His turnover should be below 2 crore rupees. That is why between 2 crores and 10 crores audit was not applicable. Here eligible assessee declares profit for any previous year in accordance with the provisions of this section. That means up to in any previous year, if he declares profit under section 44AD1, that means 6% for banking channels, 6%, and for others it will be 8%. Since stock market everything is through the banking channel, we'll be considering it as 6%. If in the previous year he has declared it for 6%, and he declares profit for any of the 5 assessment years after the previous year, not in 44AD, not in 44AD1, that is 6%, he has not done the returns in such a way, then he shall not be eligible to claim the benefit of 44AD for the next 5 assessment years. That is, he cannot opt that. But you can see that nowhere it is told about audit here, and it is nowhere told that the total income should exceed the basic exemption limit. It is just telling that in the previous year you opted for 44AD1, that is 6% thing, and in any of the 5 assessment years you opted out of it. From the next 5 assessment year onwards, you will not be eligible to take 44AD benefit of doing income tax returns. Now when you come to 44AD5, notwithstanding anything contained in the foregoing provisions, an eligible assessee to whom the provisions of subsection 4 are applicable, total income exceeds the maximum amount which is not chargeable to tax. And here it is told very clearly, when total income exceeds the basic amount not chargeable, that is about 2,50,000, he is liable to maintain books of accounts, as well as he is required to do tax audit under section 44AB. And now we will go to 44ABE. Now 44ABE is telling every person carrying on the business, if provisions of subsection 4 of section 44AD are applicable, that means when 44AD gets triggered and his income exceeds a maximum amount which is not chargeable to tax in any previous year, then only he is required to do audit under section 44ABE by a chartered accountant. and furnish it before the due date, duly signed and certified by the accountant. I know there will be many doubts in us because I think many of the professionals are using Winman for this. Winman will be generating some error that you have a loss or you have it is less than 6%. You require to do that an audit. But these are the sections I have taken from our Income Tax Act. Now, anybody have a different view? We can share all the ideas here. Now, this is taken from the Income Tax Act. Yes. Now, in income tax, we were telling when the turnover crosses 10 crores. What is the turnover in the stock market cases? And no separate guideline has come up from the ICAI department. And always there is a confusion regarding this turnover cases. Now, and our institute has come up with a guidance note on tax audit. You can see it in the page number 25 of the guidance note. Now, I will try to open it here. Since this is a PDF, this is a separate page number now, but you can see here in page number 25, you can see the turnover, how turnover should be taken. We know that for a delivery based share, what will be the turnover? It will be the turnover of sales value for delivery capital gain. But for speculative, what is speculative? It will be intraday. Turnover or gross receipts should be derived in this manner. Marked here, yes. Aggregate of both the positive and negative differences is to be considered as turnover. So this is very interesting here. Now, for intraday, morning you entered a buy position, you bought it for total amount of 5 lakh rupees. By post lunch you sold it, before the trading time you sold it for 6 lakhs. So you know that you made 1 lakh rupees. You feel that you can make it more. After that you again entered trade, for 6 lakh rupees you entered the trade and you lost it was lost, and you ended up with 3 lakhs. 3 lakh loss was there. So ultimately at the end of the day, in the first trading he has made a profit of 1 lakh. In the second trading he has made a loss of 3 lakhs. So ultimately at the end of the day he made a loss of 2 lakh rupees. So how to calculate the turnover for this? This particular criteria can be used for the 365 days or the trading days and can be calculated for aggregate for the year. Now for this particular day, what will be the intraday turnover for income tax audit purposes? Now how you have to take it is the absolute value of profit and losses. Even though the ultimate loss is 2 lakhs, that cannot be taken as it has the turnover. What should you take is that without any sign you have to add whatever be the loss of the profit. So first transaction 1 lakh, second transaction 3 lakh, so the total turnover will be 4 lakhs, and that is the way aggregate of both positive and negative differences. For derivatives, futures and options, it is also like the same thing as that of speculative. Here it is told that total of favorable and unfavorable differences means the absolute differences. That is for futures and options you have to take it like that. But for options, one more thing you need to add, that is the premium received on the sale options is also to be included in the turnover. And the premium on the sale, based on the premium only you will be entering in an option, so that premium on the sale also should be considered in adding the turnover. So in case of clients, in case of traders who do options, their turnover can be so high rather than the futures or intraday. In options their turnover will be much high, so there will be much chances that there will be a tax audit liability, because their margins also are available. So if you have 10 lakh rupees, they will not be trading for 10 lakh, they will be trading for such crores of rupees. So there is high possibility even this, since adding both of this is options trading, will definitely have an impact. Yes, for delivery based, total value of shares is to be considered as the turnover. Yes. Yes, here turnover. Now whatever we have discussed, I have just put it in the slide. For delivery based, it will be the value of sales. For speculative, it will be the absolute sum of differences. For futures and options, it will be favorable and unfavorable differences in absolute terms. And for options, one more to be added, that is the premium received on sales. Yes. Now, when you do an audit of a client, they will be giving you some Excel sheet, maybe some tax P&L, some trading book, some statements or with the demat account, demat or the broker, they will be giving, every day when a trader do a transaction, the stockbroker will be giving the stockbroker will be giving to the trader or the person who invests in stock market. They will be giving a contract note. Now that is a very legal record. That is a legal record, and that why that legal record is given, and that is the transaction carried out on the stock exchange through a stockbroker, and that is a proof for them. And the contract note will be having details of the broker name, client details, the digital signature from the stockbroker, then the trading details, all the shares bought and sold, the derivatives bought and sold, everything will be there. Even the brokerages, trading charges, everything will be there. So a trader who trades daily, frequently, if they want to prepare some accounting on that, you can take the contract note, you can see the actual legal document and verify. When you get an audit, for better audit clarity, you can check the contract notes to confirm with the Excel they give. The Excel may sometimes to get it audited, with the extra evidence, you can have a contract note. Now all these details, we can see a practical example. I have taken screenshot from 2 contract notes. It will be in 2 pages. If number of transactions is more, it will be in a bigger page. I've taken this one. You can see the trade details. Shares here, S for selling, here B for buying. Here you can see options bought and sold. Now FUT, it is for future, sold and bought. All these transactions will be there, and you can see that now exchange has not done a transaction that I have not done. No, it is a cross checking. Client can cross check in the evening if we have done a transaction and before the end of the day. That means before 12 o'clock, this thing will be mailed to your mail. So you can cross verify that stock exchange, the stock broker has not done anything other than what I have done myself. And you can see here the CGST, security transactions, SEBI turnovers, stamp duty, everything for that particular day, everything is there. So now we can, this is a valid proof. And so if regular or frequent trader, our accounting for these things will be much easier. Yes. And the last portion of the income which we need to discuss is the dividend. Now there is a small change in that. Earlier it was not taxed for a shareholder. It was tax free. It was exempt under section 1034 and up to assessment 2021. Now from earlier what was there was the dividend distribution tax, DDT, under section 115. And all on a sudden that got abolished in Finance Act 2020. And now if you have a dividend of more than 5,000, and if you are an investor, or a short-term investor, maybe on the record date, if you hold that share and you get the dividend, if it is above 5,000, if the dividend is above 5,000, 10% will be deducted under section 194, and you can check the same under your 26AS. You can see that it will be deducted. So for clients or traders looking all the trading related incomes, dividend also should be checked thoroughly. Some stockbrokers tax details, sometimes they may give dividend details also, but all are not showing. So it is always now better to, and now it is easy that whether they got a dividend is easy to check. If they do not get a dividend, probably if they get a dividend, even if tax is not deducted, most probably the company name dividend amount and tax deducted 0 will be shown in 26IS. So that will be much helpful in your accounting and for your audit point of view. And another interesting thing is that for a capital investor, this particular dividend will be shown under the head income from other sources, because their main intention is to get the capital gain, and the income they got out of dividend will be shown under income from other sources. But for a trader who show everything as business income, dividend can be considered as business income itself. Now we can move towards the last portion, the third portion in our journey in this webinar. It is a tax planning tip. This particular tax planning tip is for the long-term capital gain. And this particular provision can be checked before filing the income tax return. This can be done before filing the income tax return. And I have another tax planning thing which have to be done before the end of the financial year. That means before 31st March you have to do. And first we will see about this particular provision. Now earlier in the one slide I have shown you how capital gains are taxed. It is taxed at flat rates. So all the benefits like Chapter 6 deductions, 80C deductions, 87 rebate, all those are not available since you are taxed at a flat small rates. Compared to other slab rates, it was less. So all those deductions were not available. But a 54F section can be used for long-term capital gains. If you are individual or HF, you can use this. Now, how this can be used is that the assessee should purchase a residential property. Now, if you sell a house property this year, either you must have purchased 1 year before or 2 years after. You have to purchase a residential house property in India, or you have to construct within 3 years from today. Then you can, if you have such a lot of long-term capital gain, you can have a tax planning by doing that. And few conditions are also there, like withdrawal of this thing. If you have taken this year and you have violated the conditions, later in years you need to reverse it. You should not sell or transfer the new house within 3 years, or you should not purchase in 2 years or construct within 3 years a residential house other than the house which we are talking before. And you should not own any other residential house property. And one more point it is added is that the cost of land also can be included in this particular case to reduce the capital gain and thereby reducing the tax liability. But a very difficult tax planning setup to be made for long-term capital gain, because this much provisions clients will not be in a position to do all on a sudden, but this can be taught. It can be taught well before, so that they can keep it in mind, and in future years they can have better planning and can do it in the future. Yes. Now we will move to the second tax planning thing. It is called as tax loss harvesting. It is known as tax loss harvesting. To do this tax loss harvesting, we need, one thing is that you made a lot of short-term capital gain this year, or long-term capital gain, anything, or business income. You realized those profits this year. Plus, in addition, you have unrealized losses in some shares. Now, what you can do is that you can book the losses now. Now means before March 31 for that year, you can book the losses. So unrealized becomes realized. So that losses happens. And you can buy the share immediately. You can take that, you can buy the share. So it will come to your holdings again. So what happens there is that already we have seen the carry forward and setting of provisions. Now you can set off the losses with the already realized profits that year, and thereby reducing the tax liability. So this happens only when you have realized profits and unrealized losses. But this can be a very good a very good tax planning method, but only when the client comes to you before March 31. Now, of course, we know that they will come only on the last day. This cannot be done. Now, we can tell that next year you can do that, but still they will come on the next year, the last day only. But no irregular, a person who needs proper planning will do that. But none like we cannot tell that like other businesses, people will be interested in doing things lately. But people who smartly do investing or business or trading in a stock market, no, they will be very vigilant, and they will definitely come to you before March 31 if you tell about this particular provision to them. So it will be very wise to advise on this tax plannings also. Yes, I think this is all about the webinar I can take upon today. I hope you have benefited out of this. I know there are many expert and experienced chartered accountants and other members here who know about all these provisions, but I think maybe from introduction or some other point, at least one point must have struck your mind. I hope you enjoyed it well. Thank you.
Thank you, Ashin. Thank you very much. It was really a really beautiful presentation. You traveled through all its length and breadth of the subject, and I really enjoyed it. I think everyone, the comments are coming. What a good presentation! Very nice presentation. Wonderful presentation, Ashin. All the credits goes to you. It was excellent. Really, it's an excellent presentation. Now,
Yes,
dear
thanks,
members and
sir.
students, now the floor is open. If you have any doubt, you can ask the. Well, he's a very expert and experienced. I can also say that he's an experienced person. So you can ask if there is any question, you can ask it. You can either unmute and ask, or otherwise you can put it in the chat box.
Please don't ask share tips. I'm not a SEBI registered person to give any share tips. Okay.
Actually, is there any questions there in the chat box, either personally or otherwise? And all our comments, I think.
If I am a swing trader, Mohammed Sheen has put a comment. If I am a swing trader is like BTST. You know, we were telling about BTST sales: buy today, sell tomorrow, or acquire today, sell tomorrow. You know, as you would said, it comes under non-speculative income. Yes, yes, it is non-speculative. The reason I have told is that even the stock exchanges, they charge securities transaction tax as they charge it for a normal delivery transaction. So we can consider it as non-speculative. Yes. Non-speculative in the sense it is not speculative. I meant it is not speculative, so it can be considered as a short term. Now if you are holding it for less than 12 months or less than 365 days, that means it can be considered as short term. If you are holding it even for one day, that can be taken as short term capital gain or short term capital loss. It's only short term. So a chartered accountant also can do that. You can buy today and sell tomorrow, but you cannot do an intraday. Buy today and sell tomorrow. Sell today itself. Cannot do that. Yes. So there is no need to plan for forming a company or doing as individual. You can do that as a swing trader. Also, you can do that. But always, but this will be. I don't know whether they will be taking it as a problem because the frequency is so huge in doing swing trade, but it is at the desire of the assessee to consider it as capital gain. You can show it as. Yes. Yes, Jacob sir. Yes, thank you, Jacob sir. Yes. Explain why premium is deducted in options. No, why premium is deducted means it is there in the guidance note issued by the Institute of Chartered Accountants India in page number 25. You and I can read it once again. because there is no particular provisions or there is no clarification from income tax department also. Only provision, only thing which we have is the guidance note from institute, our Institute of Chartered Accountants of India. By that only we are doing it.
Hello, Ashin. Can you hear me?
Hello. Yes. Yes.
Yeah, I'm Anand. Yeah. So I had a doubt on options turnover. While calculating
Yeah.
options turnover, actually, as far as my knowledge is concerned, the options premium is actually added with the difference of buy and sell. That is
Yes.
So in your slide, you are saying that options premium is getting reduced from the favorable and non-favorable positions. So isn't it actually added with the net profit or loss?
Yes, sir. I'll tell it. I'll repeat it again. Yes, for option premium, all the favorable and unfavorable differences must be added. And second one is the option for the premium received on option on sales should also be added. So
Yeah.
these two should be added to get the turnover. Yes, sir.
Yeah, fine. Because
Yes, and that's why I told.
I saw in the slide like there's minus sign put. So I thought you were saying to reduce the premium, option premium.
No chance, because for turnover calculations, there is no plus or minus. No, everything is taken in absolute. But if there was a mistake, I'm very sorry about that.
Perfect.
I could not see that. Yes.
Got it. Yeah.
That is why I told that for option premium, the turnover will be much higher than the other type of income that you get, because two types of turnover will be added here. Rather than futures and speculative, this turnover will be much higher.
So it's same for the option buyer and the seller. It's
Yes.
Okay, fine. Thank you.
Yes, thank you, sir. Yeah.
Anything further to be clarified? Ashin, you please share the slides so that we can upload it and you can share it to the members also, please.
Yeah, sure, sir, sure.
JP, a few words. You are muted. JP, please.
Ashin, absolutely great presentation. Your voice was absolutely great, and your rhythm and passion is wonderful. Very good study on this topic and subject. You are very confident. A great gift big gift for Kannur branch. And
Thank you, sir. Thank you.
Great thanks to the chairman Reggie also by bringing this great personality here. Absolutely great. Throughout the period, I'm traveling from Calicut to Kannur. Throughout the journey, I have gone through your entire presentation. It was absolutely great.
Thank you, sir. Thank you so much.
I think Rajesh has made one question in the chat box. Money can be gifted to immediate family members, right? What is the limit for that? Similarly, share can be gifted to immediate family members. One question I could see here.
Yeah, sure. You can gift. This is the greatest gift you can give to your son, daughter. Greatest gift. Some parents, they were holding all the shares and they are giving it to next generation. We must not have thought about that. We must have been getting from generation ancestral property like land and building, but shares are also gifted like that, and there is no tax for that. There will not be any tax. Only thing which I have noted in the slides was the holding period. The holding period will be taken from the previous owner. So even if you get it and you are in need of money, you will sell it within the next day. It will not be short term. It will be long term. If they were holding it for more than 1 year, the previous owner. Yes.
I think one question is from Kumar Bhatt sir also. Rajik, could you please read?
Yes, please.
It is told by you that once trader, every year it continue as business income. Whether it cannot convert to stock in trade to fixed asset. You can see your question, but sir, question in the chat box.
I've repeated what the circular 6/2016 have told. In 6/2016 circular, it is clearly told in the second point, if the assessee opts a particular transaction as capital gain or loss or a business income, he has to continuously do it for the subsequent all years. So he cannot change it. He have to plan it accordingly.
Right. Another question from Bhattu sir. I'm reading that. Can tell some points regarding bonus issue. We can see one question from Bhattu sir.
Bonus issue.
Yeah.
Even bonus issue of shares, to tell about bonus issue, these shares we get as extra. So there will be the cost of acquisition will be taken from the it will not be added to the capital gain computation and all. Now there is interesting point in that this bonus share rights issue, further public offer, all these have been given a lot of exemptions. Now that needs more clarity on that to be given, and I'll come back on that particular answers. Yeah.
I think there is no more questions in the chat box. If members have any other questions, you can please ask. Otherwise, we can go for the winding up.
Alvin Matthew have asked a question that what if you are pyramiding the shares and sell it after? Now, in the holding period, in the holding period slide, I have shown a practical example that you may buy 100 shares today. You may buy after 6 months another 100 shares, and if you sell after 1 year from today, only the shares you bought today will be considered as long term. After 6 months you bought, and in next 6 months you sold it together with the first two transactions, that second of 100 lot you bought will not be considered as long term. It will be considered as short term only, because that holding period for the second purchase was only 6 months. Yes.
Okay.
Can select which one to sell. Usually they are doing first one first out, so that will be the method they will be using it. Yeah, correct. Yes, thank you, Jitu. Yes.
Okay, Ashin, once again, I thank you for the wonderful presentation, and all the very best to you. We will definitely have this like of topics in future also. And now
Yes.
I request our Secretary CA Shiprasad sir to kindly propose the formal vote of thanks. Shiprasad sir, please.
Presiding Officer, Chairman of Kannur Branch, Chartered Accountant PJ Reggie, auspicious learner speaker and brilliant Chartered Accountant Ashin Kurian Tom, my dear professional colleagues. It pleases us to note that Chartered Accountants from new generation are coming forward and are presenting the papers extremely well. Kannur Branch is proud because of exceptionally talented youth wing which marks progress. Today's speaker, CA Ashin Kurian, presented the paper in such a way that it is not the first time. Well presented, well prepared, and well presented. We express our sincere gratitude to him. Thank you, CA Ashin. Wish you all the very best, and let many more presentations come from you. All the very best. I express our sincere gratitude to the chairman of Kannur Branch, CA PJ Reggie, for presiding over the seminar, for finding out the right persons for the right topic, for the motivation, and for the outstanding leadership. For success of any program or seminar, participation is most important. We value the participation, and we are very much grateful to the members for your support, motivation, and for your gracious presence in this seminar. Wish you all very good health and well-being throughout your life. Thank you once again.
Thank you. Thank you, Ashin. Thank you once again. JP, thank you. Siva sir, thank you. Thank you all.
Yes, thank you, sir.
Thank you, Ashin.